Good morning and welcome to Almus Market Mornings, your daily dose of global financial updates with me, Swaraj. Markets have broadly remained rangy due to lack of any major data this week, but we do have some important data points coming up which can move the markets. We saw some respite in dollar strength overnight, though not anything of major significance. But how the market is positioned is something important to know. If the market is positioned $2 bullish with the expectation of United States relative economic outperformance, any of the upcoming data which may prove otherwise will result in some dollar sell-off. Let's find out from JK. JK, ahead of the key data releases, how do you think markets are positioned?
Good morning, Swaraj. Yes, it was a very dull day yesterday. Though dollar was seen somewhat weaker, mainly driven by some fall seen in the yields. And it was again a very thin market. And this is considered as a unofficial, last week of summer vacation. And therefore, labor holiday falling next Monday would be the end of this vacation, and you should be actually looking at the current moves as very short term, driven by near term events, and nothing as a directional move. Therefore, it was just all within the range. There was quite a big drop in the 2-year yield yesterday after a successful 45 billion new issuance by the Treasury. And thereafter, we saw the dollar slipping, gold gaining, and also equities rallying strongly as well. In fact, equities in China actually led the morning rise. Chinese stocks opened with a big gap of almost 5% and then dropped to just 1% gain. And that was quite disappointing because China had lowered, taken several measures, lowered stamp duty, and then also the included other measures like reducing margin ratio, encouraging companies to do buybacks, and fund managers to purchase their own equity funds. All these, intended to boost the stock market sentiment, but that fizzled out at the end of the day. But not worrying about the Chinese lack of reaction. Equity markets in Europe and US actually went up, and I mean that was quite positive for the investors. All the major US indices advanced, but again they closed off the session highs. Once again, no big factors there. All waiting for important data ahead in the week. The currencies also had a diverging trend. Euro and GBP recovered with the fall in short-term US yields after having threatened to break below the strong technical supports on Friday. But surprisingly, yen has remained weak, as well as the commodity currencies, which have been subdued, still reeling from the uncertainties besetting the Chinese economy as well. We did have some very underwhelming data on the loan part in the Europe, and we saw both the lending to corporate as well as the individuals credit slowing quite a bit from June, and that was indication of the tightening financial conditions and credit offtake being affected. And also we had a big contraction in M3 and M2 growth in Europe, and this was again indication of lowered money supply and possibly a good news for inflation because the demand might be tapering off in the coming days. So despite whatever hawkish talk from some of the ECB members and Lagarde holding on to her previous stand, I think Eurozone eventually might see lower inflation as well as a pause in the interest rates. And interestingly, on the other side, US Market Watch shows US rates might be up by 0.25% in November, and that probability has gone above 50% now. So that's the sentiment in the market. But once again, these can be impacted quite a bit from the upcoming data. We have consumer confidence data from Germany and France today, which are expected to hold steady. But the US consumer confidence, which actually rose big last month, is more keenly watched. And then we also have the JOLTS job data today at 7:30 p.m. India time, where the job openings have fallen quite a bit in the last 2 months, and expectation this month is also for further lower number. And this is the first of the series of several job market indicators to follow, like the ADP private jobs report tomorrow, challenges job cuts, and weekly jobless claims on Thursday, finally ending with the all-important NFP on Friday. There also declined to 1,70,000 from 1,80,000 is seen, in August. However, investors would be very cautious because jobs data in the US have always tended to surprise the analysts, and therefore one would be not surprised to see a market remaining non-committal on their positions and remain more rangy in this week and waiting for new direction to emerge in the coming days. Nothing different was happening in the USD INR as well. We saw a reversion to very small range during the day yesterday. Of course, we do have some concerns on the Indian economy, particularly from the monsoon side, because August monsoon has been very disappointing, and it has been the lowest in the last 10 years. That is actually following more than average rainfall in July. But the Met Department says that this can also have an impact on the El Nino, rather can have an impact on the September rains as well. So overall for the season, they are expecting a 8% shortage in the monsoon rainfall compared to 4% that was predicted initially, and this can have a lot of impact on the food grain production, eventually leading to tapering of the rural demand. Therefore, I think Indian equities could be quite subdued ahead of the final picture emerging from the inflation as well as on the demand side. We are seeing rangy moves. FI inflows have been quite minimal in the last few days. Notwithstanding the larger picture, India showing big, large, record growth compared to other countries. The near-term challenges are somewhat negative for the equity markets, and also perhaps keeps the rupee range bound. Maybe today and tomorrow we will have influence from the month-end related flows. We usually have some index-related funds inflow and then followed by outflow as well. So these could be ruling the day-to-day moves. But I think even in the rupee as well, we will look for direction in the global markets in the coming week. Look for a rangy movement in the next couple of days. Thank you.
Thank you, JK, and well summarized a rangy movement in the next couple of days. Yesterday, we saw the US 2-year yield drop due to successive issuance of $45 billion worth of bonds. When it comes to China, China had lowered its stamp duty and taken some other initiatives to boost the stock market, though the reaction fizzled out in the end. What's interesting is the rate hike probabilities for November is increasing. So markets are increasingly pricing a rate hike of 25 basis in the next Fed meeting. Jolt's data is expected today, so expectation is of a lower number. Basically, it is an indication showing the number of job openings in the economy. When it comes to USD INR, it reverted back to its small intraday ranges, and it can remain a range bound in the coming few days. One important factor is the August monsoon, which has been disappointing. As JK mentioned, it has been the lowest in the last 10 years, and it can possibly impact the food grain production as well as rural demand. That's it from us today. Tune in tomorrow for the latest developments in the financial markets. Thanks for listening.